Hello, everyone, and welcome to another installment of Investing with IBD podcast. It's Justin Nielsen here, along with Arusha Peiris, who joins me pretty much every week. And he is a portfolio manager over at O'Neill Global Advisors. How are you doing, Arusha?
I'm doing well, Justin.
It looks like you have a different background. There's no offending USC and Raiders helmets in the background, so that's kind of nice to not see.
It's nice and neutral for you now. I'm in
Nice and
Cincinnati,
neutral,
Ohio.
exactly, just what I was looking for.
Yeah.
And then joining us on the show today as our special guest, it's April 26, 2023, and we've got Ken Shreve, who is a senior markets writer at Investors Business Daily. And gosh, Ken, you've been there for a long time now. I know. I remember when I first started in customer service, you were in the back, you were answering emails, you were on the education department, and of course, those emails were coming through AOL.com. Back in those days, we had investors.com. We did own the website, and it was like a single page that just basically said, "Here's what Can Slim is." So yeah, Ken
Those
knows,
yeah
way
those
back.
those were the days. I actually first came to IBD mid to late 90s, right in the middle towards the tail end of that great bull market of the 90s. Certainly have known you and Arusha for quite some time. So glad to be with you guys as always.
Yeah, good to have you, Ken. So we'll be taking a look at the markets, of course, as we always do. It's ever changing, and this week has certainly added some extra complexity to the market outlook. We'll also have a deeper dive into healthcare. Ken's going to take a look at some of the medical stocks, how they're holding up, and then, of course, we'll finish up with a look at some specific stocks that are on Ken's radar. So let's go ahead and start out with the NASDAQ. You know, the NASDAQ, of course, was getting all the attention because it was the strongest of the indexes. But we've been talking about on IBD Live, on the podcast, wherever we can, how the indexes have been masking some weakness underneath the surface. And it seems like that weakness kind of came to the forefront this week. What's your take here, Ken?
Well, yeah, it was a tough session for the market on Tuesday when we had that pretty violent sell-off. It was pretty amazing that we didn't get higher volume on the Nasdaq, so we somehow avoided a distribution day Tuesday. And then we had that strong earnings report from Microsoft, and the Nasdaq was up 1.4% intraday, and it really couldn't hold that gain. I think it closed higher by 0.4% or something like that. So, and that was a pretty solid quarter from Microsoft. So we're going to get a lot more earnings reports to come. We still have Apple, seeing Meta trading nicely higher in after they reported earnings. So market looks vulnerable here, though. No question about it. We still have a fairly mild distribution day count, 3 on the NASDAQ and 2 on the S&P 500. But again, just kind of below the surface, you're just seeing a lot of lackluster action. And even when the NASDAQ was up sharply after Microsoft's earnings, breadth was still couldn't turn quite positive. It was either flat or slightly negative. So breadth is an issue here, and the risk level has been elevated for a while, and it's just a little more elevated now, I think.
Yeah, Ken, I think you nailed it right there. I mean, this has been a narrow rally, and it keeps getting more and more narrow, and maybe it's like maybe the last 4 remaining, right? The large cap tech stocks are going to try to carry this NASDAQ higher here. But so how should listeners, or how do you kind of balance this, where it just seems to be getting more and more narrow, a little bit more distribution days are coming up. We broke the 21-day moving average, which is so important with the way we analyze the markets. You know, how are you handling this type of environment?
Well, as a member of the leaderboard team, and Justin is involved as well, you know, we have been lowering exposure. We got up I think close to 70% not that long ago, but have scaled back to a little below 50%, I think, at this point. So we have some names that are still working that we're willing to spend some time with. But you know, we did a lot of trimming on Tuesday when the market was selling off. So it's really just a time to be favoring a pretty decent cash position. And you know, even though we're still in a confirmed uptrend. The uptrend is under some pressure here. It's just become a more difficult environment to make money in stocks. So you hear the expression a stock picker's market. It probably is that, and you can find some things out there that are working. But when you buy a good setup and you're just not sure where the stock is going to go, is it going to reverse in heavy volume? Is it going to act well? It's just a tough environment. So a little bit of exposure makes sense, but taking some money off the table here, also makes sense, especially in some of your big winners. You may not want to sell all of it, but you can, raise some cash and just play a little defense.
Yeah. And I mean, speaking of leaderboard, I mean, one of the reasons for the higher level of exposure was because a lot of the stocks were working. We had
Hmm.
we had gains on them, but we were very quickly seeing a lot of those gains deteriorate. I mean, just look at ALGM as an example. We had a nice cushion on this. I think 30% gain at some point, and it just it came down to 45, which wasn't too concerning. Looked like it was going to get support at the 50-day moving average line, and then it just started really, coming down a lot sharper, pretty quickly. And so, it's that kind of shift in something that was looking so strong, just all of a sudden, kind of turning tail. That's kind of the treachery of this market right now.
Yeah, definitely. And I think, chip stocks are looking vulnerable. Obviously, ALGM is in a lot of trouble, firmly below the 50-day moving average. Even a name like Rambus, which delivered a really strong breakout in heavy volume and looked like it was going to hold those gains. That one really got dragged down during Tuesday's sell-off and really didn't make tried to rally back above the 50-day moving average and kind of closed off high. So the chip stocks are looking vulnerable here. But again, this whole healthcare theme and medical sector, we still have a lot of groups that rank up near the top of our 197 industry group rankings, and I think it still probably an area of the market if high multiple tech stocks are going to be under pressure here. It's probably not a bad sector to look at.
Hmm.
Yeah, and I think it's good that you're bringing up the healthcare sector because not only is it timely, but it probably gives a little bit more indication of the market itself. We're seeing a number of these semiconductors, a number of the tech stocks starting to collapse. Meanwhile, you're starting to see the healthcare, staples, utilities starting to act better. So we're having that rotation, but I'm not sure if it's good for our type of stocks or our type of environment.
Right.
Yeah, and this is a market. Justin and I joke, we're on IBD Live, and we're going to be talking gold stocks because gold
Yes,
stocks are
exactly.
outperforming, and the consumer staples, and your hospital stocks and things. So technology stocks, under pressure here. It's possible that we could continue to see a rotation, which makes the healthcare sector, medical sector look as interesting as it has. There's still a lot of good stocks setting up there, and it's if you want to play defense, it's a pretty good sector to be in.
Hmm. Now let's talk a little bit, maybe getting back to the indexes. One of the things that was looking attractive and a little enticing was how tight they were starting to trade. I mean, you look at the Nasdaq Composite, and it seemed like this extra volatility was kind of settling down. If you looked at the VIX before today, before the last couple days, you were down almost at 16, so a very low level before it kind of shot up over the last few days. And again, that was even with the backdrop of a recent banking, crisis and all of these things just really didn't seem to shake things. And here we were tightening up on the indexes. What does that say to you? Like that tight action and then the break that we had yesterday.
Well, I mean, just looking at the Nasdaq, when it hit that high of 12,227, and then it really was kind of a gentle pullback to basically the 21-day moving average, and it was holding there. It was holding the 12,000 level, and it was frankly a setup that I think it could have delivered a nice upside breakout, but it just didn't materialize. Again, we had the big sellers come into the market Tuesday. We didn't get a lot of volume, like I said, on the Nasdaq, but that trip right down to the 50-day moving average was sort of like a warning shot. So the technical picture changed in one day, and that was on Tuesday during that sharp decline. So still holding here, and a breakout over 12,000 is still possible. We're just going to need to see signs that institutional money is coming in from the sidelines. We really have not seen a whole lot of that, frankly, for some time.
Mm-hmm. And taking a look at the S&P 500, anything to add here? I mean, the S&P 500 started looking a little bit stronger, and I mean, it certainly was holding its 21-day moving average line a little bit better until yesterday. Still has a little bit more space above its 50-day moving average line, but it was down today, whereas the Nasdaq Composite was still up. Again, probably indicative of what was happening with some of the mega cap Microsofts and so on.
Yeah, looks like we got lower volume Wednesday, so we might have avoided the second straight distribution day for the S&P 500. But yeah, this is going to be a test of the 50-day moving average. Either it's going to bounce and find support, and if it does, you'd like to see some volume when it finds support. You want to see signs that the kind of big money is buying. So the test of the 50-day looks imminent. The 4,000 level is just below that round number, just below the 50-day moving average. So it's kind of do or die time here for the S&P 500 as well.
Yeah, and what's interesting, we only recently started to pick up some distribution day in the S&P. It seemed like the distribution day was going more towards the Nasdaq side over I guess since the fall through day.
But exactly.
Yeah.
We had kind of like a clustering of distribution days. It was between April 5th and April 12th. It was just over several days where we saw three of them, and two of them were one was down 1.1%, the other was down 0.8, 0.9%, the other one was fairly mild, down 0.4%. So it doesn't look like a market right now that's under major distribution, but again, it's just looking a little vulnerable here, and we're hoping that tech earnings are going to lift the market up here, but that might be a big ask, because the numbers were pretty strong from Microsoft, and their guidance was pretty strong, at least revenue guidance, and the stock was up 7%. It definitely, sellers knocked the stock off its high for the day.
Mm-hmm. Yeah, and maybe I think because the indexes are showing obviously one aspect of what's going on. But as you said earlier, Ken, it is masking a lot of what's going underneath the surface. Maybe talk about a little bit more about leaderboard, how you can get that gauge, right? Where are you making some good progress? Because there are times, once every few years, where all of a sudden everything lines up, or maybe it's a few months of the year, everything lines up and things work just really well, and you just start putting on points on the board, and you're like, wow. Where has this been? Why isn't it always this easy? Maybe talk a little bit about that, where you're seeing that, like on leaderboard, kind of just the progress, or kind of just getting chopped around.
Well, it's been a lot of being chopped around, as I'm sure you can relate to, and that's what makes the market conditions so difficult. We've done well with on holding, that premium footwear maker. That was an earnings option trade. Nvidia's been a nice winner for us. So we've got profit cushions in some select names, but when it comes to kind of new buys within the past week or two, that's where it's been kind of we've been getting chopped up and really not making much progress, and that's really your cue from the market. If things really aren't working, you need to just learn to be patient and know when to kind of sit in cash, because we're in a difficult environment right now where you just don't know. You can buy a stock with good fundamentals and good technicals, but if there aren't institutions around buying, and you're not riding their coattails, it's anyone's guess where the stock is going to go. So you can follow rules, and which we do, but in this type of market, this range bound market, again, if you have a 10-15% gain in a stock, you're usually better off selling or taking a profit, because that gain can disappear pretty quickly.
Hmm. And, again, kind of it speaks again to this breadth issue. And I mean, Matt Caruso was on last week. He was talking about the new highs versus the new lows, and the new lows are still kind of overwhelming there. The advanced decline line, if we, take a look at, for instance, GMIAA, that was really looking like it was starting to improve for the NYSE, but, kind of took a turn down for GMIAB on the NASDAQ. That advanced decline line didn't really get the launch that the NYSE was having, and so that one is actually kind of going to new lows. And then it's also probably worth looking at RSP, which is the S&P 500 equal weighted ETF, and you can see a very different picture on this one. When you take out those mega caps, and the heavy weighting that they get, and put everything on equal footing, this index is showing a very different picture. This looks like something that struggled to get to the 50-day moving average line, got turned away right there, and is not looking as healthy.
Yeah, I mean, when you just look at the normal market cap weighted S&P 500, that's still holding above its 50-day moving average, and then you just look at the S&P 500 with all the stocks equal weighted here. I'll tell you, looking at this chart makes me feel good to have a healthy cash position. So it's really a breadth story right now, and we need to see that improve, and we know what needs to happen for that to improve, but just so many headwinds out there. We're right in the middle of first quarter earnings season, and oh, by the way, we still have these concerns in the financial sector. We've got a key reading on inflation at the end of the week with the PCE deflator. So there are just so many moving targets out there. You can understand why it's been a difficult environment to make headway. And the XLF here, same sort of situation. Converged moving averages, and under a lot of pressure down, what was that, 5 days in a row.
Yeah. And probably worth mentioning, the Russell 2000 index. I mean, it does have a little bit of a heavier weighting in some of these regional banks that have been really struggling, and this just again is a very different picture when you're looking at the 2000 small cap index. Um, below the 200-day moving average line, below the 50-day line, and nearing the lows of March, which were undercutting the lows of December, January. So a very, very different picture looking at this index.
Yeah, no question about it. So small caps, small caps under a lot of pressure, and new highs, new lows, not showing what we want. Breadth weakening. You have some stocks out there that are still working, but those are kind of the exception, and not the rule. And I think the goal as an individual investor is just to have as many things working in your favor as possible. But in this type of market environment, it's a lot more than just good fundamentals and a good chart, because in this type of market, good fundamentals and a good chart often don't amount to much.
Right. Well, when we come back, we're going to talk a little bit more about the prospects for the healthcare medical area. Some stocks setting up there, but could they suffer from sector rotation? And is this the light at the end of the tunnel that we're looking for? So stay tuned. We'll be right back. Investors with concentrated equity holdings often have a reluctance to exit their position due to the potential tax burden and other considerations. This creates an unbalanced risk profile in their portfolio. The North Coast Concentrated Stock Triple Play strategy uses options pricing models to help clients in these situations hedge risk and create premium income. The proprietary approach also makes use of North Coast's market exposure model, which looks at 40 different data sets, and a stock scoring model, which considers more than 20 factors. For more information, visit www.northcoastam.com/triple-play. Welcome back to the Investing with IBD podcast. It's Justin Nielsen, your host, along with Arusha Pires, who joins me every week. He's a portfolio manager over at O'Neill Global Advisors. And on the show this week, we also have Ken Shreve. He's one of the favorites from IBD Live, one of the co-managers of Leaderboard. He's a senior markets writer at Investors Business Daily, and we've been friends for over 25 years now. So,
oh my God.
Ken, yeah, I know it's getting up there. So, Ken, let's talk a little bit about healthcare now. Healthcare, I mean, it's a very broad kind of sector. I mean, you've got on the medical side, you've got the biotechs, which can be their own animal, just with the speculative nature of those, the FDA announcements, and phase 3 trials, clinical trials, all of the things that can happen there, merger and acquisition activity. So much there. You've got the products, you've got the systems equipment, you've got the hospitals, you've got the big drug makers. So how is someone to make sense of all of these different areas in the medical sector and kind of figure out where that strength truly is?
Yeah, well, I mean, if you're looking at XLV, I mean, this was a pretty sharp drop down to the 200-day moving average. You might think, why would I want to be invested in the healthcare sector? But like you said, Justin, I mean, we have 14 different subgroups in the healthcare sector now. Healthcare, medical, kind of synonymous, but we've got 14 subgroups, medical related subgroups, and there's quite a few that still rank in the top half of our 197 industry group rankings. So while the XLV has come under some recent selling pressure, I'm still seeing a lot of good setups, and we talk about. We talk about new a lot when evaluating a stock, and there's just still a lot of good kind of news stories. And some of these news stories are coming from stocks that have been trading for a while, but so understanding what a company is doing that's new, that is kind of expanding market share and driving market share gains is important. So you really need to just get used to kind of analyzing an individual industry group, finding out how strong the leadership in the group is. Is it just one or two stocks leading, or are there 4 or 5 stocks that are showing strength in a particular industry group? So the fact that the medical sector, the healthcare sector, still has quite a few groups, ranking pretty well based on 6-month price performance. I think it still makes it a sector worth watching a lot of really high quality names.
Mhm.
So, Ken, do you generally like to, by trying to find the strength, say within the healthcare sector, do you generally try to go from industry group down to the stocks, or more the bottoms up approach, where you're looking at stocks and noticing, hey, these are all in medical products?
Yeah, most of my stock screening, Arusha, is just on individual stock basis. So it's not like
Okay.
I'm going to look at a sector and go top down and say, okay, who are the top stocks in this sector? I'll look through screens and see which stocks are rising in heavy volume. Just which stocks are piquing my interest, and if I happen to see several that are in the medical sector or healthcare sector, that might get me working a little harder to find out other leadership opportunities in the sector. So I start with the individual stocks, and sometimes it might be as simple as looking on the homepage of investors.com and the stocks on the move screen, and maybe
Yeah.
seeing some healthcare names in there, some medical sector names in there, the IBD 50, the Market Smith Growth 250, but seeing enough good action in several healthcare stocks that tells me it's a sector that is still home to a lot of potential market leadership.
hmm And it's interesting that you say that because in the medical sector, there are a few very large industry groups. For example, the medical biomed biotech in MarketSmith, we use a code for that. It's G8063, and that kind of shows you what the biomed biotech area has been doing. But there's 791 stocks in there, so I really think that the bottoms up approach is kind of the way to go, because if you're thinking, oh, okay, there's something going on here, there's very big disparities sometimes between these stocks. And medical products, I mean, that one is up there too. There's 140 stocks in that group. Medical systems equipment, there's 75 stocks in that group. So yeah, a lot of these groups are kind of in the top number in terms of how many stocks are in the group, and so that can be a factor there in terms of sometimes there's leadership of, let's say, 10, 15 stocks, and unless they're the high priced ones, it might not even show up in the industry group.
Well, this is a pretty great thing about MarketSmith too, because we're looking at the biotech group right here, a weekly chart. But if you just go over to the right navigation and just go to stocks and group, and then show all component data, and you just get a huge list of stocks in the group. And here you can sort by relative strength rating. You can sort by the dollar amount, how much the stock is up or down on any given day. You can even sort by volume percent change to see which stocks are seeing the heaviest volume up or down. And you can see volume was very heavy in several biotech stocks today. So, MarketSmith is a great way to evaluate an industry group. If you just go back to the weekly chart, we also list the top 5 stocks based on their relative strength rating, and that is there you go, and you can see these some of the leading biotechs. I'm not going to talk about any of these names, but some of them are Vertex got hit with some selling today, but the biotech group is huge. But I still like to look in this group because there are so many great stories, so many great pipelines, and there's a lot of profitable biotechs out there as well. And if they're not profitable, there are plenty that are showing huge revenue growth thanks to a marketed drug. So like this group a lot, and it's definitely a place where you can find some nice winners.
Mhm. Rusha, just to kind of get your take, because I know that you actually kind of had some work that you did in the medical area, and kind of some of that research and everything like that. Um, with some of these speculative names, I mean, I was just noticing as Ken had you look at the stocks in the group. I mean, the ones that had some really heavy volume, I mean, they were trading for 50 cents, some
Right,
56
exactly.
cents, and some of those. So the point I'm making here is there's a lot of very speculative names in this area. Is there anything that you do to kind of just make sure you're dealing with higher quality and the less, a little bit lower risk? Uh,
Yeah, I mean, well, generally, kind of like what Ken said, usually for me, one of the first areas that I start to go through on the weekends is the Mark Smith Grow 250.
mhm.
That's just casting a wide enough net. And what I'll look there, you'll just start seeing the higher quality names within a biotech or medical products start to come into those screens. So a lot of times that's usually how I find it. If I have a bunch of time on the weekend, maybe every once in a while, I might just quickly scan through some of the biotechs here. But yeah, a lot of these biotechs that are under, a few bucks, I'm just moving on. I'm not really paying too close attention to. I've always done better in higher price stocks anyways.
Yeah.
And so even with the biotechs, I think a good screen for me is to just sort by the higher price ones, and then Regeneron's at the top of the list, right? So that's generally how I do it. I prefer to stick with biotechs that actually have earnings and sales.
Mhm. And then Ken, about the story, and this is where sometimes it can be a little tough, because I always find that there's like this little bit of push and pull. I mean, it's hard for me to follow a lot of the stuff. I mean, I took genetics in college, and a few biology classes. And I really like reading Alison Gatlin's stuff, because I feel like she does a really good job of breaking down what's going on in some of these you know in some of these areas, why their innovations are important. But kind of getting to that end factor, that new factor, what do you kind of do in order to kind of get your mind around the implications of what some of these companies are doing, how they're impacting the healthcare area, and what prospects they have, and what risks are involved with. Okay, look, if you've got this great idea, but if the clinical trials don't go the way you want, and these can be very years long processes, gosh, how much wasted time is there, and how quickly do you have to change those valuations?
Yeah, it's. I mean, listen, the biotech. There's. Sometimes I'm just incapable of fully understanding. What a company that I'm looking at is doing. I will go to their website, and I find that the really quality biotech companies are going to tell a very good story on their website. They're going to have a very clear investor relations section. They're going to have a very clear pipeline section where they show what drugs are in what stages of development. So I really do get a lot of my information from the company's website to start. You mentioned Allison Gatlin, who does a great job covering the biotech industry for us, and she also, like you said, does a very good job of breaking down complicated subjects to layman's terms. But I think when it comes to a biotech, Arusha mentioned, you want to avoid those that are talking a good story. They don't have any revenue, they don't have any earnings. Fund sponsorship is still very, very light. You want to focus on the stocks that are showing nice increases in fund ownership, for example. I don't mind buying an unprofitable biotech as long as there's meaningful revenue growth, and that's one of the stocks I'm going to talk about. Isn't profitable, but it's showing really, really strong revenue growth in recent quarters, good fund sponsorship. So these are some of the things to look at. I would avoid the super speculative ones. Look at the higher priced stocks in the group, and don't think that buying a biotech stock at $1. Thinking that you're going to make 50% on your money if the stock goes up 50 cents, that's going to most likely be a long road. So look at the higher price names in the group, look at those that are seeing rising fund ownership, and then look at those that are, that at least have earnings and sales, or at the very least, good revenue growth.
Yeah, and especially in markets like this, you become a lot more appreciative of stocks that are institutionally owned. At least they'll have some of these stocks that have a lot of funds. They're going to come down just a little bit nicer than some of the others that really somehow one day they can start cratering.
Yeah, and you just have to know the trading personality too of some of these biotech stocks. Some are just prone to volatile price swings, and but then again, some of the higher priced institutional quality stocks tend to trade in more orderly fashion. So it's always it's a big group, but sorting the group by composite rating, it just gives you a good idea of who some of the companies that are executing in the biotech space are, and there are really no shortage of candidates. Biotech stocks, frequently find a home in the Market Smith Growth 250. You'll find them in the IBD 50 as well.
Yeah, and I think it's worth mentioning that in terms of Bill O'Neill, who was the founder of Investors Business Daily. I remember as I was working with him. In 2000, 99, 2000, I was very, very picky about my CanSlim stocks. I had read the book, and I noticed that he was getting into some of the medical, stock areas, healthcare areas, and they didn't have earnings. And so it was one of those things I asked him about. Specifically at that time, it was really the Human Genome Project. So you had, gosh, I don't even remember what the name of the company was. HGSI was the ticker symbol, but they were working on the Human Genome Project. Watson, of Watson and Crick fame, Nobel Prize winner, was heavily involved. And I remember him saying, "Look, with some of these, with some of these companies, they might not have the earnings, but the new is just so compelling that he was willing to give those a shot." And he's had a number of medical stocks over the years. That, I mean, Amgen was one of those that is kind of of storied fame. Back in the 90s, when they had a product that was just phenomenal in terms of what it was doing for chemotherapy and cancer patients. Less less damage to their white blood cell counts. And then, of course, the one that kind of started him on his pathway to business was Syntex, way back in 1963. Of course, they did the birth control pill, one of the makers of the birth control pill. So medical
Yeah,
has been one of those areas that kept on coming up.
yeah, well, and the new, as you know, was very important to Bill. And I don't know if you wanted to, kind of categorize all the different letters of Can Slim, but I'd have to put the N right up there near the top, because anytime I used to go into his office and talk about individual stocks, the first thing out of his mouth was what's new, what's new going on at the company. So again, the biotech group is a great place to find new. You just want to make sure you're focusing on the quality names, and focusing on those that are generating meaningful earnings and revenue, and if not earnings, they're generating meaningful revenue that is eventually going to make its way to the bottom line.
Well, when we come back, we're going to talk about some of the stocks that are in this area, and Ken's going to give us his take and analysis. So stay tuned. We'll be right back. Investors with concentrated equity holdings often have a reluctance to exit their position due to the potential tax burden and other considerations. This creates an unbalanced risk profile in their portfolio. The North Coast Concentrated Stock Triple Play strategy uses options pricing models to help clients in these situations hedge risk and create premium income. The proprietary approach also makes use of North Coast's market exposure model, which looks at 40 different data sets, and a stock scoring model, which considers more than 20 factors. For more information, visit www.northcoastam.com/triple play. Welcome back to the Investing with IBD podcast. It's Justin Nielsen here, your host, along with Arusha Piras, a portfolio manager over at O'Neill Global Advisors, who joins me pretty much every week. Much to my dismay sometimes, but usually my pleasure.
And I think I've only missed one episode in the last.
I know. I've missed as many as you have.
But you're just harping on.
But when you do, I miss you so much whenever you're not here. So, and of course, joining us this week is Ken Shreve, someone that I get to see on a regular basis on IBD Live, and gosh, we're on Zoom daily chatting with each other. So even though he's in the office and I'm at home, I feel like I don't miss you at all. I get to see you all the time.
Likewise, I'm sure.
So Ken Shreve, of course, is one of the senior markets writers at Investors Business Daily and one of the co-managers of the Leaderboard product. So before the break, we were talking a little bit about the medical area, the healthcare area. We were spending a bit of time on the biomed, biotech in particular, but maybe we start this segment off with the medical products. And if you're on MarketSmith, you can pull up this chart by typing in the code. Every industry group has a code. So in this case, it's G2831. And this kind of shows you what the medical products industry group looks like of the 197 industry groups. And this is number 10. So talk to us a little bit about what you're seeing on this chart here, Ken.
Yeah, I mean, I think it's interesting to look at industry group charts. It's not paramount in my stock research, but when I look at the medical products group, which as we said ranks pretty high up in our 197 industry group rankings. When I look at how this group has moved since the end of last year, first of all, on the weekly chart, I'm seeing a lot of big blue volume spikes on the weekly chart. So it definitely looks like it's a group where money is moving in here. So all those big above average volume weekly bars points to a group that to me is most likely filled with some strong stocks. So we want to start with Inspire Medical, INSP. All right, let's take a look at Inspire. So you're talking about a company that has the new in spades here. I don't know if you see these commercials on TV that people suffering from obstructive or sleep apnea, and they have to wear this very cumbersome headgear, to deal with this affliction. And what Inspire has come out with is basically an implantable device, minimally invasive. It's inserted just under the clavicle, basically monitors patients' breathing at night and sends nerve stimulation to open the airway when breathing becomes difficult. So there's this little remote that you put on the side of your bed. You turn it on before you go to sleep, and then when you get up, you turn it off. But if you're having issues at night, Inspire Medical's product, does a good job. So here's an example of a company that is not profitable, but here you've got really big revenue growth. You can see over the past several quarters, I mean, 70% minimum growth over the past 6 quarters. So this company's product is being, widely adapted. It's still in the early stages of being adopted. So it's still a compelling growth story here. If we go to the daily chart for Inspire, I like how this kind of came up through the 50-day moving average with some volume. And again, look at the volume spikes on the daily chart here. Still looks to me like a stock that's under accumulation. Now you've got earnings coming out next week, I think, but wouldn't be surprised to see strong results here. I think it's in a reasonably good technical setup. So it's an earnings report I'll keep an eye on next week, and we'll see how it responds to earnings. But there's enough here. The fund sponsorship that we haven't talked about is also quite good. It's been increasing, and I think we've got several of funds in the mutual fund index that own shares as well. So I would call this pretty close to A or A plus fund sponsorship. So checks a lot of boxes here, and I think it's a stock that has potential. We'll see what the earnings report looks like next week.
Yeah, what's interesting about this also is it is forming a pretty constructive cup right near all-time highs. So if it gets through that earnings report, maybe it has a powerful breakout and into all-time highs. So that would be a pretty significant move right there. I mean, this is almost what a year long, a year and a half long type of base right there. Oh, and then the relative strength line hitting new highs. So it seems like everything's set up now. They just have to come through with the earnings.
Yeah, when David Ryan is on IBD Live, he comes on once a week, and he often likes to talk about kind of big, long bases. So that's a good point,
Yep.
Arusha. This is a big, long consolidation, and the monthly chart looks good. And again, this company's product has been adapted quite nicely. But as far as I can tell, there's still plenty more expansion here, and so I think it's one worth watching. Again, it's not profitable, but it definitely checks boxes in terms of revenue growth. It checks boxes in terms of fund ownership, and it's in a good technical setup as well.
Yeah, a few other things that I find interesting about this. It's a pretty recent IPO. The IPO was back in 2018, and I know that was another thing that was kind of checking off a new box. Those new issues, and a lot of times we would look at things that were within the last 8 years. So this definitely qualifies in that regard, and certainly it's one of those afflictions that, I mean, there's a pretty wide market here. I mean, I think I was reading something where 1 billion people, that's B with a a billion with a B,
Wow.
1 billion people worldwide do have that obstructive sleep apnea.
Hmm.
So and certainly, I mean, ResMed was one that we were talking about for quite a while. They make those CPAP masks. RMD is the ticker symbol there. And certainly, I mean, if you get something where it's a little less a little less onerous to use, I mean, that's certainly going to help improve
Yeah,
quality.
it's a minimally invasive procedure, and it takes a couple of hours. You're kind of in the morning and out in the afternoon, and so it just seems quite compelling. And if you've seen the headgear that a lot of people have to wear, it just seems like this is a new treatment for sleep apnea that again is really company is proving through that huge revenue growth that I think it's got something here.
Yeah, very good. What else you got for us there, Ken?
Well, also in the medical products group, I think it makes sense to take a look at Dexcom.
Hmm.
DXCM, and another stock here that is kind of coming off a pretty sharp sell-off when it corrected down close to $70 a share. It's been rallying back up, and it's in the kind of this long sideways consolidation. So we're going to hear from Dexcom pretty soon, but this is a company that has the last two times it's reported. So third quarter results and fourth quarter results, the stock really shot higher. So not saying it's going to happen this time along, but Dexcom does continuous glucose monitoring for diabetics, and again, a positive response to earnings. The last two earnings reports, this company is not showing the growth that Inspire Medical is, but still showing double-digit top line growth, and you got pretty good earnings estimates too for Dexcom. You talk about sleep apnea being a big market for Inspire, and obviously diabetes is a big problem in the U.S. It's one out of two Americans are pre-diabetic. I think I heard something like that.
Oh, wow.
They don't have diabetes, but they're possibly on pace to get it. So demographics look good here. So again, wouldn't be surprised to see strong numbers from Dexcom, and it's in a good setup here. So earnings tomorrow. We'll see what the results look like.
Mm-hmm.
Yeah, and a lot of institutional sponsorship right here too, right? So and it looks like contra funds slowly starting to increase their position over the last couple of quarters.
Yeah, so the sponsorship block in MarketSmith is excellent. I always, if there aren't funds in the IBD Mutual Fund Index that don't own a stock, that's not a deal breaker for me. But at least with Inspire and Dexcom, you got really healthy fund ownership. And look at Dexcom. I mean, it's got more than 2,000 funds that are in this stock, and Inspire was well below that. So think of Inspire's fund ownership at the end of the first quarter. Yeah. 656. So Inspire is a stock that I still think could be discovered by more mutual funds. Dexcom, it's not over owned, but a lot of funds are in this, and again, the technical setup looks pretty strong here.
Mm-hmm. It's funny that you say over owned, because I was going to ask you, like, is there a level at which you start saying, well, gosh, you know what, this is no longer as new. The institutions have already kicked the tires on this. They've already kind of bought into the idea, and all of the ones that have bought are probably in there. So is there ever that fear? I mean, Arusha pointed out, rightly so, that Fidelity is still, they're increasing their position. So just because they have a position doesn't mean they can't increase it. But is there ever a concern when you've got something with so much institutional sponsorship that is there a level of when that becomes too much?
Yeah, I mean, not really, because in if I'm dealing with a stock that has 1,500, 2,000 funds or more that own it, I'm going to make sure that there's something new going on, that the fundamentals are there, that the growth prospects are there, and the technicals are there. So and I think with Dexcom you have all that. The rate of sales has declined from, say, what it was a year or two ago, but the company's still delivering strong top line growth, and again, those annual estimates I think still point to a compelling growth story. So with the fact that 2,500 funds own the stock, I don't think because of that reason Dexcom is going to have a hard time making headway. If the numbers are good and the outlook is good, this could deliver a nice breakout. We'll see.
Yeah. And one thing about, these product companies, sometimes it's not just about the product they have now, but there's updates, right? I think, what is Dexcom on the G7 now, or something, so they are continually updating and getting better and better technology that is, easier to use or more effective. And, that certainly can add to that revenue potential and earnings.
Yeah, and there are other, PODD is another company in the diabetes space. But when you look at this one's still hanging in there and fighting a good fight. It's above its 10-week moving average. So you look at the medical products group, and there's a bunch of high relative strength stocks. But I think in the diabetes group, Dexcom is probably your leader. pod is right up there, but so we'll see. Earnings tomorrow, and wouldn't be surprised, like I said, to see a good quarter.
And I think those work, kind of hand in hand, right? One does the monitoring, the other one does the infusion part, So
Exactly.
yeah,
Yeah.
so kind of a 1-2 punch there. What else you got? I know that outside of the medical products, you were also looking at like ITCI.
Yeah, let's take a look at ITCI in the biotech group. This is a stock. Let's go to the daily chart. You see there was a really bullish gap up, and this is when the company reported some late stage trial results of its only approved, its only marketed drug right now is a drug called Caplida, which is used to treat bipolar depression. Now they released late stage results of a trial that they did with Caplida, where there's a possibility there's going to be an expanded label for this drug. But you can see Intra-Cellular is another non-profitable biotech, but you've got the triple-digit revenue growth. That 87.9 million in revenue that they did at the end of the fourth quarter was all Caplida, the bipolar depression drug. So the way the stock has traded since the gap up has been pretty compelling. Again, a lot of higher volume gains here. So not surprising to see an accumulation distribution rating of A-. And we're getting in kind of choppy market conditions here, but this whole time, ITCI is kind of testing its 10-day moving average. It's been drifting lower and mostly light volume. And then we go to the weekly chart. Looks to me like it's forming the pattern recognition is recognizing a little bit of a handle here. So it's it's a bit of an awkward looking consolidation on the weekly chart, but again, I'm just kind of looking at that phase 3 trial news that they had several weeks ago. Here it is, right at the top of a long consolidation, and I like the revenue growth. And here again, a company that is showing pretty good fund ownership.
Yeah, and also
one of
getting
the things,
the blue dot, right?
yeah,
Relative strength line hitting a new high while it's building a base.
Exactly.
And one of the things we didn't mention on the other two, but it really just sticks out to me here: the R&D, research and development, 53.8% on this one. I mean, you usually expect a high R&D numbers from a lot of these innovative companies in the biotech field, but man, 53%, that's pretty incredible.
Yeah, and so you can kind of forgive the company for not being profitable because they're plowing a lot of that revenue into research and development. So this company is making great inroads and treatments for the neurological psychiatric disorders. So I think that the pipeline looks very good here, and like the revenue growth, like the fund ownership, and it's a stock that is saying I should be looked at here.
Mm-hmm. Now, another stock that is kind of in the systems equipment area. This has been around for a while. Intuitive Surgical, ISRG, but their last earnings report, I mean, they got a nice jump off of that, and gapped up above a base, and seems to be tightening up here. What's your take on this? And are they doing something new, or what's kind of got the attention of people?
Well, they've got some new going on. I think what is most interesting is that they have this kind of relatively new machine called the ion endoluminal system, and what they can do there is they can go in and perform a minimally invasive biopsy on the lung to detect early lung cancer. So this is another product that ISRG has. Again, it's called the ion endoluminal system that can detect early lung cancer. Now, this company made its name from the Da Vinci robotic surgical system. 3 out of 4 prostate surgeries are done using the Da Vinci system, so it's still a very popular surgery for the Da Vinci system. the gap up on earnings, anytime a stock gaps up like Intuitive Surgical did and starts holding gains and trading sideways means that the stock should be watched. So I'm watching it. Had a chance to look at the earnings report. Their procedures were up much more than expected. Again, they're kind of coming out of COVID, so more people getting these elective procedures done. They're expecting procedure growth to kind of fall back to the mean of 18 to 20% thereabouts. But the company showed that there's still pretty strong demand here. The revenue growth up 14%, not huge growth, but it was a nice acceleration from what they did in the fourth quarter. And again, the fact that the stock is holding gains here after the gap up tells me that it's possible we could see a new entry. It could just buy time underneath the 300 level here. If the market uptrend can gain traction, you could see a new entry here. But just like the quality of the gap up on earnings and the way it's been digesting gains, including today, it tried to come down to the 10-day moving average, and on a tough day for the market, it closed up near its high. So there still seem to be buyers around here supporting the stock. But good earnings report, nice acceleration in revenue, and flat earnings this year, and then 18% growth expected next year. So it's an older company. They've been around for a while, and arguably maybe past their best days of growth, but really solid large cap name, and you can see that monthly chart having a good month so far. So I think technically it is setting up nicely here after that gap up.
Yeah, it was really 2004 where this kind of captured people's attention again with that Da Vinci robotic system. But as you mentioned, it's not, didn't have a too shabby 2017 and beyond there, and we'll see if it can maybe have another go at it. So
yeah, this is not a stock that is going to return 3 or 4 times the S&P 500. Maybe back in 2004 when this thing was really moving, it was giving huge returns. So it's a more mature company, but they're still executing well, and I think that latest earnings report was proved that, and showing strength and support after that gap up. So I like the way it's trading.
Mm-hmm. Well, thanks a lot for those ideas and for the overview of the healthcare sector and where it stands right now, Ken. Really appreciate it. Thanks for coming on.
Thanks, guys. It's always good to talk to you.
Okay. And that'll wrap it up for us this week. Next week, we're going to have Ed Carson on. So I feel like we're kind of doing the quarter century club. We had Dave Chung on, we had Ken Shreve on, and Ed Carson, of course, is also a member of that quarter century club at Investors Business Daily. He's our news editor, and so it'll be good to talk to him and get his take on what's happening in the market and some of the things he's looking at. So thanks for tuning in this week. Hope to see you next week. Take care.